And here we are.
Hey, man, we're
Good
live.
morning.
Good morning. We're a little earlier than we normally are. But yeah, good to see you. So, are
Good
we
to see
ready to
you.
start formally?
Let's do this thing.
That's the coolest thing ever.
All right. This is Stephen Earp.
And this is
I'm Taylor Davis.
Taylor Davis right there.
And we're here today. We want to talk about just the market and what's going on in the market today, right?
Yeah. So, welcome to the Real Investing Show. If you're watching, we've got a few people watching live right now, or if you're listening on the podcast, thanks for joining in. We try to put out an episode a week, and we talk about all things real estate investing. I've been involved in real estate investing for close to 30 years now, and in some form or another. And Taylor's been investing for a really long time as well, and also has 14 years. And also has a large team of agents in Norman, Oklahoma, and so we've been doing this for a long time.
So I feel like this is the topic that's on pretty much everyone's, like, even if you're not investing in real estate, the state of the market is always something intriguing to people. It's one of the things that, as a real estate agent, people will ask, and want to have a conversation around the market on a pretty regular basis.
Yeah.
So, first off, you've been doing this much longer than I have, and you were way more active as an investor through the last crash.
Mm-hmm.
Talk to me about some similarities that you see, man.
So first of all, I feel somewhat inept when it comes to predicting what the market's doing, where it's going, and things like that. So
that means you're probably somebody worth listening to.
Okay, so I approach, like, if someone were to ask me, here's what's happening, and I know you read all the stats and all the details, and you keep up with all of that. I tend to just see what's happening right now and try to make adjustments based on that. So here are the things that I see that are similar. Number one, everyone who's not a real estate investor has an opinion on what the market is doing, the real estate market, and what the market's going to do, and why it did what it did, and all of the couch potato meme champions on social media that have never put, and let me be gentle and careful about this, because I know right here with me is a bona fide licensed real estate agent, but I would also include in that real estate agents that sometimes know some stuff but don't put their own money in deals. And
or they come from a very localized perspective or very personalized perspective, as opposed to really kind of looking at national trends and data.
Yeah. So similar things I see to the market now, and the crash that I was deeply involved in, and at the 08 and 09. Lots of people started having opinions about the market, so you started hearing about the market a whole lot.
Right.
That was similar. Change is always scary, so that's similar. But besides that, 08 and 09 was very different than what we're experiencing now. Like, the reasons behind it.
Oh, yeah.
And the challenges behind it and things like that. And so I have thoughts about what might be happening. I have thoughts about what the future might bring. But here's what actually happened and what we actually did in 07, 08, and 09. And by the way, did you ever see the movie The Big Short?
Big Short. I was literally sitting here thinking, like, if someone listening to this hasn't watched the movie The Big Short,
yes,
you really need to go watch that to have a clear understanding. Because that is all, it's almost documentary level. Yeah, while it's an entertaining film, it really is what took place, and put in a perspective that you, the viewer, can understand. Because there were a lot of financial big institutional failures and failures of oversight that took place that Main Street never saw, right? Like the guy that lost his house in 2008 didn't know exactly all of the factors that went into that.
Right.
And
well, and so
perspective.
Yeah, and a little bit of the factors that went into that was the subprime mortgage crash.
Right.
And here's what happened. And by the way, when everything went down really bad, at the height of it, I had 3 full-time construction crews working for me.
Wow, I did not know that. I mean, I knew you were doing a lot, but
yeah, and I was making payments at one time on 8 houses that we were rehabbing.
And while market is dropping at about the same rate that it's been going up over the last
year. It was dropping. And here's what's happening. The market was not only was the market dropping, but I had houses under contract, and we would go 3 weeks to get all of their packet submitted for the mortgage lenders, and boom, the mortgage lenders would change the requirements, and it was another 4 weeks to 6 weeks, and then boom, they would change the requirements again, and then that buyer doesn't qualify anymore. I mean, like, I had a house in Purcell, Oklahoma. We had it under contract 4 different times, and then finally a local bank, a guy put like 50% down on the property, and a local bank, ended up loaning him the rest of the money. And so, so as far as similarities, the only similarities that I know of for sure is that the market's changing a lot, and nobody really knows what's happening.
Boom. I agree with that 100%. Yeah. There are similarities in that we all feel something, right? We're all very aware, and markets are made up of the collective's feelings, right? And so we're all very hypersensitive right now that there is some kind of a shift or a change happening.
Right.
We don't really know what that is or what that looks like exactly.
Right. And I mean, I follow lots of investing content online and social media accounts with investors and real estate developers and things like that. And if you want to get content to go viral on social media, then what you should do is make some really strong statements about exactly what the market's doing, why it's doing it, and what's going to happen next. Yeah. I mean, like, if you think about what actually has happened, is interest rates are going up, up, up. So I mean, so because of nationwide housing shortage, and you might could speak to why all that happened, and I know COVID contributed to it, and lots of other things contributed to it. And long term, our mortgage rates were like so low, and they're just now climbing up to levels that they've historically been closer to. But like with interest rates going up, of course that's going to impact the buying. And so my perspective is, in every market, as an investor, in every market you can make money. It's just all about how you make money, and you just kind of shift your strategies. So it's never, to me, market shift is an opportunity.
So before we and I definitely want to chat about what we've gone through, but real quick, I have to ask this question. Yeah. Did you make money in 2008?
Yeah. Oh, yeah. Yes.
Did you make money in 2009?
Yes. Yes.
Would you say that those 2 years were the bottom of the market?
They're the bottom of the market. Well,
where you were investing, was it 7, 8, or 8, 9? Somewhere in there, right?
It was somewhere in there. Yeah. Yeah. Okay. I mean, the market was lower when I first started, but I mean, I bought my first house when I was 19, and I'm 47 now. So like the market was lower, but that at that point in 08, 09, the market went like a huge drop.
So when that happened, were you doing the exact same strategies that you were doing at the peak of the market in 04, 05?
I was doing more of it.
You're doing more of it. Okay.
So what happened? Yeah. And I did get caught. Like,
okay.
I didn't lose actual money. I lost imaginary money that I would have made if the market had stayed where it was or had gone up. I didn't actually lose money.
So when did you pivot? When did you start changing your strategy?
Well, I was chasing my tail for a long time because I had these houses under contract. So what I did is I took house by house, because I at one time I probably had 5 houses under contract to sell, and I had 3 others that were being rehabbed, and that's when they were changing mortgage requirements, and I was losing my buyers right and left. What I started doing is people couldn't qualify for loans, And so all of a sudden, I just started doing lease purchases with people. And then all of a sudden, guess what? The house that I was going to sell for $105,000,
you're now selling for 115.
I'm selling it for 125, and they're paying me $10,000 down, and they're paying me a huge payment monthly.
Because and here's the deal. So some people are going to hear that and they're going to go, "That's not fair. Like that's not right." Blah blah blah. The truth is you're solving the problem that buyer has in that they can't buy a house.
They couldn't buy a house from anyone else. And so
you're solving the problem, and you're taking on a risk that the bank wasn't willing to, but it was a win for you as well.
Yeah.
Because you got out of the property and actually ended up making more.
Yeah.
I'm going to guess that you cash flowed on your payment there.
Oh my gosh. We way more than cash flowed.
Okay.
Like on those deals, because people were looking to buy, and it was like I was doing lease options to people, lease purchases to people who had been under contract and lost it because they can only qualify for a subprime loan. So I got killed in the short term, but long term it was a huge win. Let me give you one example. Can I tell you about one specific house?
Love to hear it.
Because it just came up. This is a house in North Oklahoma City, and it had been a burnout. And we paid for, it's a 3-bed, 1.5 bath brick home. And now we had to gut it. Okay. Sure. We bought it, and this was in maybe 05, 06. I don't know. Like it was early in that. And we bought it for like $8,000. Okay.
Wow.
And it was a rental neighborhood that at the time was Section 8, but it was all brick. North Highlands, if you know that area.
Yeah.
So
I do.
Paid $7,000 or $8,000 for it. And the homeowner, it was a burnout, and the homeowner that owned it had gotten a full payment from their insurance. And so for them, it was like $7,000 or $8,000, and then they stopped getting the liens on it because of them not repairing it. So we went in there, we did a total rehab. We rented it out a few times. And then during the subprime thing, I was actually, because the market had gone up and up and up and up, and I'm like, I think I'll sell some stuff and put it into something else. Well, then my buyers on that house couldn't qualify. So here's what happened. This lady came, and she couldn't qualify for a regular loan, but she had a job. She had a little bit of money down. We took like a $2,000 down payment. We sold her that house for $60,000, and we carried it on a 15-year note for her. Okay.
Yeah.
And it may have been 20-year note. I don't know. There are 3 years left on it right now. Like she's still in the house.
Oh, wow.
Yeah. That never happens, but yeah, she's still in the house.
That's rare.
Yeah. And so she's never been late in all these years. And so she recently messaged me to check on what the payoff is. And I was looking at it. So that refreshed my mind on it. I was like, oh my gosh, she'll have this thing paid for in like 3 years. And that house is probably worth $95,000 now in today's modern market. And I mean, just think of it. She could not. Now the house at that time, if we had sold it to someone at that time, we could have only sold it to an investor. There's no way we could have sold that house for more than about $45,000 to $50,000. We sold it to her to get into a home for $60,000 and carried it on a 15-year note with a pretty decent interest rate for us. And she couldn't have gotten a house otherwise. And it's almost paid off.
She put $2,000 down, and 15 years later, she's going to have a paid off house worth $100,000. Even though this was a quote unquote unfavorable loan for her, right? Like, I mean, it's a little bit higher interest rate. The payments are going to be a little higher because of it. But the alternative was she rents, right?
Yeah.
And here's an interesting.
And that same house, if she was renting that house right now, if she'd kept renting, her payment would have been $400 a month by now as to what it is.
Right.
Because we were willing to sell it to her on terms, and we've carried it this whole time. So we made tons of money, and we did not have large tax implications on it because we sold it over time on terms.
Right.
So yeah, I would do that. I wish I could do that 100 times over. So that's something we did.
here's a really interesting statistic, and she falls under the homeowner now, right?
Yeah. Yes.
The average homeowner, the median net worth of a homeowner in the United States is $255,000. So the average net worth of someone who owns their home, $255,000. The average net worth of a renter is $6,300. $6,300. That right there is one of the main reasons that I love home ownership. It can change, like for that lady, it changed her generational wealth. Okay.
Yep.
So I want to come back to real quick to what we are seeing in the market. Some of the similarities, a lot of the differences, historically what's gone on, and then how to prepare as an investor for what that looks like, right? Like what is the best path forward? So an interesting statistic that I came across recently is this has never been the case before. 51% of homeowners have a sub 4% interest rate. So meaning they're in the 2 or 3% interest rates, right? That not 4 and above, but below 4%, 51% of homeowners. So when you compare that to right now, the average interest rate's hovering around 6%, right? You have this competition, not with other houses or things like that, but you're really competing with their own interest rate, right? Like, why would I sell my house at 3% interest rate and go buy a house down the street that's similar, maybe a little bit newer, maybe a little bit bigger, but I'm going to pay 6% interest rate? Because here's the difference is, I mean, for every $100,000, just to put this in perspective, for every $100,000 that you borrow, and so in today's market in Oklahoma, the average is going to be roughly $250 is your average price point, somewhere in there.
Okay.
So let's say round numbers is 200,000. For every 1% on that 200,000, you're paying $2,000 more a year in interest, right? So if you're going from a 3% to a 6% and you're in a $200,000 house, either way, you're going to end up paying $6,000 more a year in interest for that same payment. So you start to get this
$500 a month,
right? I mean, this is a very significant thing. We're not talking about $60, $70 here. So now things are still moving. Things are still going to continue to move. There are always going to be people that are in a life situation where they need to change. I mean, we saw that in 2008. And by the way, if you bought a house at the top of the market in 2005 and you went through that crash and it hurt, right? On paper, it hurt. But if you stayed put, by 2013, you were fully recovered to your price. So at least national average. Okay. Actually, in places like Oklahoma, you recovered quicker than that. But national average, 2005 to 2013, to get back to the same price point, which follows, and typically a real estate cycle is 7 years. And that tracks real close to that. Now, we brought in some quantitative easing and some other things that the federal government or the Federal Reserve did to ease that. The problem is now this is a totally different issue. And one of the issues that we have right now is an inventory problem, right? So just to put this in perspective, Oklahoma City, their MLS, that multiple listing service that all of the houses go on for the realtors, they are it really services the whole metro and kind of some of the outlying surrounding areas. On average, we used to have somewhere between 6,000 and 8,000 homes on the market at any given time. Right now, we have about 3. So we are far lower in inventory than we normally. Now, compare that to where people typically start the buying process before they think about selling, right? Like, you know what you want to know what your house is worth, but really you got to go find the house first before you put your house on the market. Right. Well, we have this very limited inventory right now, and we have higher interest rates. And I'm not going to put my house on the market until I find a house that I want. So this kind of creates this slowdown in number of transactions. And that's what we're seeing is a slowdown in the number of transactions. We're not seeing prices drop. We're seeing prices leveling off because, and this is an interesting stat, houses were actually more affordable in 2020 and 2021 as prices were skyrocketing. Prices were more affordable than they were in the 80s. When you compare your average income to the 80s and you adjust, it still was a smaller percentage of income to own a house, even though you're paying so much more for that house because of the interest rate. That interest rate changed.
Yeah. I mean, early 80s. I mean, I was a kid, but early 80s, like I had grandparents that were real estate investors in the 70s and 80s. And like in the 80s, you had like adjustable rate mortgages in the teens.
Yeah.
My 13, 14, 15, 16% interest rates.
My grandpa was telling me the other day, we were talking about this.
Yeah.
And he was in the oil field and he bought a nicer house in I think it was 84. Yeah. And he paid 24% interest on that property.
Yeah.
24% interest.
Yeah, man. And I don't know, like, so in the mid to late 80s, the savings and loan crash here. And I remember that because my family, because again, my grandparents were real estate investors. My aunts and uncles were all real estate investors at the time, and they were developers. And so, I mean, I remember being a kid. I remember being a 10-year-old kid and hearing about like savings and loan crash, and that was connected to the oil bust here in Oklahoma. Yep. So the oil bust and the savings and loan crash of like 1986, 1987.
Penn Bank went down. It drug everyone down in Oklahoma.
Yeah, and before that, see, when I very first started, this is a little nostalgia that's probably irrelevant for most of our listeners. But when I very first started in investing in real estate, you could still find assumable loans.
Yeah.
And of course, there are other ways we do it now, but back then there were ways to actually assume someone else's loan.
So interesting, and this is a good tidbit because I do think that this is an area where savvy investors, because we talked about, I mean, you had to pivot, right? You had to pivot in 08, 09 from just selling the house like you normally did to doing a lease purchase. And the faster someone, if there's one takeaway that someone takes away from this, the faster you pivot, the more you'll win, right?
Yeah, totally. Yeah.
You have to pivot quick.
Yeah. And you know what?
You got to be on the front edge of it.
Totally, man. And you know what? Something else. I was telling because I partner with my daughter and son-in-law on some local rehabs and stuff. And I was telling them, like, when the market is questionable or the market is hard, that's when you want to buckle down, because half of everyone else is going to quit and leave the market.
100%.
It's an opportunity. When the market gets hard, it's an opportunity for the people that don't quit.
And here's what it is.
Yeah.
The market has a problem, and the first person to solve that problem wins.
Oh, yes. Yes.
So when you get in this shifting market like what we're seeing right now, we know there is a problem to solve. How do we solve that? And the first one to figure that out will win. And these tactics that we've used in the past, we can use a bunch of those, but most likely we're going to have to tweak those and maneuver those to today's market. And going back to the assumable loan, you're right. They don't have conventional assumable loans anymore. They haven't in a long time.
Right.
However,
since like the late 80s.
However, for our veterans, VA loans are assumable. So if you are a veteran and you qualify for a VA loan, you could assume someone else's VA loan, and you may be able to get that in the 2s or 3%. Okay, so we'll come back to that. And FHA also has assumable products. So if the person that you're looking at buying a house from has a VA or an FHA loan, you need to look and see if that's an assumable loan. Because if that's an assumable loan, the numbers that you're going to be able to pay for the house are significantly more, which is a win for them.
Right.
While you're getting a lower payment than what you could get even at a lower price, right? Because if I'm able to assume a loan at 3% versus me going out and getting a loan at 6 or 7% as an investor,
Yeah.
My cash flow is so much better. I'll give you more for that house.
Yes.
But now I can cash flow and take that.
Yeah.
So that there are still these opportunities. You just got to know where to look. And so FHA and VA are an opportunity.
I personally love it when the market gets wonky and people get nervous. I love it because I love trying to figure it out, and I love trying to make the fast changes. And it's like, I'll try this. Oh, that's not quite what I wanted. I'll try that. Not quite what and then like shortly we will figure out the right combination. And when we do, we're going to multiply it and do it over and over and over and over until the market changes again.
And every entrepreneur just shook their head yes, and every non-entrepreneur went like to that idea, right?
Hey, listen, when you start talking about, man, the market's real scary right now, seriously, that gets my like adrenaline going. I'm like, yes, bring it on, because other people are going to drop.
One of my favorite quotes, and it comes from Warren Buffett, who is the greatest investor of all time, basically.
Right.
He's going to go down as one of the best.
Yeah.
When others are greedy, be fearful. And when others are fearful, be greedy. And that, like, if you see people running for the hills and they're scared, that's where your opportunity lies.
Yep.
Right. If you see everyone going into one thing, be careful.
Yeah.
Right. Because that's most likely a bubble. Right. And so we have this really awesome opportunity. Right. So real quick, I'm going to summarize how we got to where we are in 2 minutes.
Okay. Do it.
So we're going to go back to 2005, right? 2004, 2005, building is hot. Everyone's developing. Everyone's building. Lenders are extending themselves. Everyone's buying. If you could breathe, you could buy. Okay? Right. Then crash happens. All of these financial institutions pull back and restrict. By the way, like over 50% of home builders declare bankruptcy. Okay. So you talk about ripping the Band-Aid off. That hurt. And it took builders and developers and lenders all took a step back and said, we're not doing this right now. Right. And over the last 14 years. So from 2008 until 2021 was the first time that enough building permits were pulled in the United States to keep up with population growth. Okay. So we had this drought of 13 years where we weren't building enough to keep up with population demand. Okay. So, well, we know how markets work. It's supply and demand. So that has caused prices to increase at a fairly dramatic level. Now, what kept that affordable was interest rates dropping. So as these interest rates dropped and prices went up, your affordability metric was still there. But we still have this underlying inventory problem. And we still have it today. Look at just even in the local market, we have 3,000 versus 6,000 to 8,000. We have to build our way out of that. So there's this underlying problem there. That is going to be the long-term fix, is building our way out of it. So it's not the same, because before it was this bubble that was created by buyers that shouldn't be able to buy. And now we have this other issue that's kind of under there. But we also have people that are experiencing a lot of inflation, right? Everyone's experiencing this massive inflation right now. And there's a lot of people locked in at a really low interest rate. So you're creating what they call stagnation, right? So there's inflation that is actually stagnating the market because of the inflation. So because the interest rates are so low on my fixed rate house, I'm not entering the market and I'm not creating that circular market. So that's where we're sitting right now. They have to increase interest rates in order to fix the inflation problem. So we're going through this same problem that we had. Now, the question is, where do they stop? Where do interest rates stop? Right. And that's the piece that's going to shift this market. But where we're at right now is we have to find creative ways to get inventory moving in order to be successful investors right now. and we've got to compete with a lot of these lower interest rates. Does that make sense?
Yeah. No.
So being creative, whether that's maybe finding an assumable mortgage or doing a subject to, right? Like that's an old school method that has some implications that you got to work through.
Yep. Which what's interesting, you mentioned that the last 4 or 5 months, I've looked at that more and I've started doing subject twos again.
Yeah.
For a long time, I completely swore off of them, but with the right disclosures and the right plan and the right house and the right seller, right now, I think a subject to is a home run in many ways. Finding deals like a subject to where you're taking over someone's mortgage subject to their existing mortgage, owner finance where people are just financing the home for you. There's some of that as an investor. Probates and people going into nursing homes, those are a big opportunity right now for people who want to buy,
baby boomers are retiring at a crazy rate right now, and a lot of them need to downsize.
Yep, a lot of them need to downsize, and a lot of these homes, they're outdated back to the 1970s. They need significant rehabs. I mean, man, some of the houses I've looked at lately, it's like, okay, this is an $80,000 facelift on this house, and so those are opportunities. Also, another opportunity is investing in multifamily, which is growing and growing and growing, which you and I have been working on a lot more recently. So you can invest in multifamily and commercial property as a passive investor, which is if any of you listening or watching are interested in partnering with Taylor and myself on some bigger projects, let us know if you have resources.
It's a way to leverage a little bit of money for a larger gain, right? So you're able to play and compete with these hedge funds that are coming in and buying these all the houses, and you're able to get in and the nice that we'll have to tease this because we're coming up on our time. But one of the things that I love about commercial versus residential is the leverage is different. Like the way you make money in commercial and the way you make money in residential is completely different. In residential, I'm really looking at the market around me to determine my value. In commercial, you're really just looking on the amount of money that property is bringing in to determine your value. And so there's a totally different lever point. Should we touch on that next week?
Yeah, we can talk about that. So there's several topics we've mentioned that we could probably expand on at some point.
Perfect.
Finding deals in this market, subject to
and creative
financing deals. Commercial.
I gotta do this real quick. By the way, I've been around a lot of investors, and guys, I don't know that I've ever been around somebody as creative as Stephen Earp. Like,
oh man, you're too kind.
No, I mean for real. Like the one thing that I love about real estate, and I love to do this, and I learned this from you. There's always a solution. We just got to find it, right?
Dude, and thanks for saying that. Thanks for saying that.
I love it. So
you just filled up my tank. I'm good for another. Like it's like you just put air in my tires. I can drive for another 100,000 miles. So kind words. You don't even have to pay me to do this podcast anymore. You can
good.
Say something nice about me once a month. So awesome. So those are
we've got several contents we'll come up with on the next one. So we'll look at creative, we'll look at commercial versus residential.
So let us know, guys. Those of you who are watching, let us know in the comments or send me a message or send Taylor a message. What do you want to hear about the most? Do you want to hear about how to find deals in this market? Do you want to hear more about subject to financing or seller financing? Or do you want to hear more about commercial? Let us know. Let us know what you're most interested in, and we can tackle those topics one at a time. So good stuff. I love hearing your expertise on the market, bro. One thing about the great Taylor Davis is you actually keep up with the market, and you know what's happening.
I find it fascinating. Like for me, it's just it's my entertaining reads.
Yeah, that's not weird at all. Reading financial news on your spare. I'm sure you take your family down to your lake house, and you're like, "Hey, kids, enjoy the sun. I'm just going to read.
I'm going to read about the market. It's actually fairly true.
I'm going to read about why things happened in the
I got to know. I got to know.
Yeah, I know. So, well, I love you, man. I love working with you. And yeah, so we'll
next week.
All right. Blessings to you guys. Let me hit our dealio. We can say goodbye the formal way. Thanks for watching the Real Investing Show, guys. And let us know, especially if you're interested in partnering with us on larger commercial deals, multifamily, or if you're looking for an agent in the Oklahoma City metro area, you can work directly with Taylor and his team. Or if you're looking to buy or sell property in any part of the United States, Taylor can help you get connected to the right people to do that. So any closing thoughts, Taylor?
You nailed it.
All right. Blessings, guys.